Well, welcome everyone. My name is David Sandu, and today we're going to be talking about taxes in retirement. I'm excited for everyone to be here today. We have a lot of things to talk about and a lot of things to consider as you're planning for retirement. Like I said, my name is David Sandu. I'm a financial advisor. I'll introduce myself here in a minute, but just want to go ahead and get started. Just before we get started, make sure everyone understands, and anything we discuss here is not meant to be taken as specific tax, financial, or legal advice. This is general and informational and educational in nature. If you have questions, you're welcome to set some time up specifically with your questions, and we can talk through those. So just want to make sure you understand nothing in here is meant to be taken as specific tax, financial, or legal advice. So who is this class for? Well, it's mainly geared towards people that are pre-retirees or retirees that want education on how to build a steady stream of tax-efficient income in retirement, strategies and ways to reduce their taxes in retirement, understand the healthcare landscape in retirement, especially as it relates to taxes, and really develop the peace of mind that comes from having a comprehensive financial plan. So if that sounds like you, then you are in the right place. And I want to introduce a couple of people from our team, but the first one being Becca. Becca is the Director of Tax Services at Wise Wealth. She also offers tax preparation services. She's busy doing tax prep for our clients and for a number of others. But if you have questions about tax prep and you'd like to reach out, feel free to schedule some time and we can get you her information and get connected. So that's a little bit about her. Just wanted to introduce her so you know who she is, and if you have questions about preparing for your taxes, you can get help for that. Today, we're going to be talking about tax planning, meaning looking into the future. And before we get into that, I just want to mention, a little bit about me. So I'm a former rocket scientist. I've worked at SpaceX and Raytheon and Lockheed. I was creator of the Rethinking Your Retirement Roadmap that allowed us to pay off about $100,000 of college student loan debt, save up an emergency fund of 1 year, to give over $150,000 in charitable donations. And we'll be talking more about giving later today. And finally, to pay off the mortgage on our house. And I've been able to, and thankful to teach and advise hundreds of other families to accomplish similar types of goals quickly. I just want to briefly share a little bit about my story, just so you have some context about who I am and why I got into the financial services industry. So this is actually a picture of me and my father. About 10 years ago, my father passed away, and that's really where my story started. Like I mentioned, I was a rocket scientist. I was doing work as an engineer and building rockets and developing that technology. And really, when he passed away, it was a shock to all of us. And after he passed away, I had to walk my mom through a lot of those tough financial planning questions. And so that really, that process of helping her obviously was very tough, but it also gave me the spark to want to help other people. I got to teach Financial Peace University at my local church, and then at the community center around the area. And that really gave me even more of a passion to help other people with their finances, and specifically with their retirement planning needs. And so that's when I found and joined the team of financial advisors that I'm with now, Wise Wealth. And so I've been there for a number of years, helping to implement comprehensive financial and retirement plans, and really just develop peace of mind in people. And that really leads into, our mission. And that's really about financial education and financial wisdom. And so the mission of Wise Wealth is to guide families on a path that makes work optional, and to design a plan that empowers the freedom to give, serve, and enjoy life like never before. At Wise Wealth, we're known for education and simplicity, and specifically financial education. And we believe that financial education should take someone from information or knowledge to transformation or wisdom. And I always say this, but I liken it to tomato. So everyone knows that a tomato is a fruit, but wisdom is knowing not to put tomato in a fruit salad. And so we believe that by making the planning process simple, we can help people avoid confusion and really build and instill confidence in them as they plan for retirement. And we do this through our proprietary planning process called the Simplify Your Retirement Plan, which is actually based on the book that the founder of our firm wrote called Simplify Your Retirement. And we'll talk more about that later. But that really gets us into taxes in retirement. And that's really what we're going to be discussing the majority of today. But to start off, I want to start by showcasing kind of the landscape of retirement planning as it exists. Because as you can see at the bottom, we believe every financial decision carries tax implications. So it's really hard to make a financial decision without having to understand the tax implications and also the estate the estate implications as well. So every financial decision is also a tax decision, is potentially also an estate planning decision. And so I want to cover some of the groundwork on some of the concerns, risks, and challenges that everyone who's planning for retirement should be thinking about, because taxes play a role in almost every financial decision that we make. So I'm going to touch on some of these items, and I'm going to start with longevity, right? So when we think about the landscape of retirement planning, really, we're thinking about potentially 20 or 30 years when we're speaking to a couple. So if you're married and you're 65 today, basically there's a 25% chance that you'll die within 5 years of each other, and there's a 50% chance that one of you will live to age 92. So if you think about retirement planning, we're talking about potentially 30 years of retirement planning. And so obviously everything gets escalated in 30 years. Inflation rises, taxes rise. A lot of implications can happen when we think about a 30-year time horizon. So when I talk about taxes in retirement, I'm talking about planning for potentially 30 years of paying taxes in retirement. And so that's what we're trying to help mitigate against from a cash flow perspective. The second risk that we need to be concerned about is inflation. And again, every financial decision has tax implications. And so specifically for inflation here, a couple of things to keep in mind is that there are two indices that are higher than the standard consumer price index. And if you'll notice on your screen, the first one highlighted where the yellow bar is more than the blue bar is medical care, and the second one is housing. And really this happens because the majority of people are planning for retirement, and then when they get to retirement, they have these large expenses because of unexpected medical expenses, but then also housing. And when you think of housing, it's mainly because of some sort of long-term care. Either they had to get into an assisted living center or some sort of skilled nursing care. So those two indices are a little bit higher than the standard inflation rate. The other thing to keep in mind is healthcare costs. And so again, we're talking about taxes, but how does healthcare incorporate into tax and into our tax situation? Well, average couple here, age 65, needs about $315,000 saved after tax to cover healthcare expenses in retirement. So again, that money has to come from potentially your retirement accounts or taxable brokerage accounts. So that again has tax implications. And I just want you to keep in mind that this does not include healthcare expenses, over-the-counter medications, dental services, and long-term care. So it does not include long-term care. This is just for a potentially 30-year time horizon of all the traditional Medicare premiums, the generic branded drugs, the specialty drugs, co-payments, co-insurance. These are all the fees and expenses you would need to be planning for in retirement. And as an example, just so you have some idea, basically where this number comes from, if you take 30 years here and then roughly $5,000 to $6,000 a year, depending on your medical concerns. And again, this is different for everyone. Some people are less concerned about healthcare in retirement, and some people are more concerned because of health issues that they may have, or because of their ancestors, right? So their parents or their grandparents might have some sort of a blood issue or medical condition that is transitioned to them. So something to keep in mind. The next issue here is long-term care. So someone turning age 65 today has almost a 70% chance of needing some type of long-term care services and support in their remaining years. So again, I just want to make sure you understand kind of the landscape as it is right now of healthcare and taxes and inflation in retirement, so that you are aware and you're planning correctly. And so a lot of people are choosing different ways and methods to pay for long-term care, and some of them might be self-funding, meaning they're just going to keep, let's say $200,000 or $300,000 in the bank ready to go if they need to pay for long-term care out of pocket. Some people are using Medicaid, and so that means that you have traditionally, spent down the assets in your accounts to pay, and then Medicaid will kick in. Again, Medicaid is not Medicare. Medicaid is a different type of government-run program between the federal and state government. Family and friends program. This was very popular. This was very popular for my grandparents. They lived with us until they passed away. Not as popular now, just because people are very far from each other. And then finally, long-term care insurance. And so we've seen traditional long-term care insurance that acts very similar to traditional insurance. And then we see hybrid-based long-term care or asset-based long-term care. And there's some benefits to that as well. But one of the other concerns I want to mention here is the stock market sequence of returns. And again, I know you're probably wondering, how does this have to deal with taxes? But again, every financial decision has tax implications. And so I'll explain how this all comes together here in a minute. But when we think about the stock market, generally, one of the things you might not have heard is something called sequence of returns risk. And because before retirement, you are not traditionally concerned at all with the returns that are happening in your portfolio. In fact, this is showing 3 different portfolios. And what this really is showing is that if you were in any one of these 3 portfolios, you would have ended up at the same amount, whether you had really good first few years or really bad first few years. And no matter how no matter how it shakes out, before retirement, before you're withdrawing money, the sequence of returns doesn't really matter. But the story changes as soon as you start withdrawing money from your portfolio. And so in this example, portfolio A has a really good first few years, and portfolio C has some really bad first few years. And again, you'll see portfolio C runs out of money. Obviously this wouldn't happen in real life. You would probably just have to readjust your spending, maybe downsize your home, readjust your income and your expenses. And so what I'm trying to show is that the sequence of returns matters in retirement because you are actually withdrawing money. And we'll show one of the reasons why you have to do that is because of required minimum distributions, a federal regulation. So we'll talk about more about that. Speaking of regulation here, Social Security regulations, one of the concerns that many people are fearful of is the Social Security potentially running out. And so the latest thing that we've seen here is Social Security, and this in the bottom left corner here, the combined OASI and DI trust fund will be able to pay in full benefits on time until about 2034. So again, not sure what's going to happen after that, but at least we know from now until 2034 that money is supposed to be paid in full. And that leads us to some of the other regulation that's happening now. The Secure 2.0 Act actually just came out this year, and that pushed the RMD age, the required minimum distribution age, to 73 starting in this year. And then that's going to move again in 2033 to age 75. And I'll explain more about that here in a second. A couple of other things that happened with the regulation, some catch-up contributions increased. There was a provision here to allow 529 plans to roll over to a Roth IRA. Of course, the Secure 1.0 forced everyone who inherited an IRA to receive those distributions out over a 10-year period. You're no longer able to take those distributions over your lifetime. And then one of the big things I want to mention here, Tax Cuts and Jobs Act of 2017, this provision is ending, so it's called a sunset provision, in 2025. So you might remember in 2017, everybody's tax rates went down, so your income went up maybe just a little bit. What's happening though in 2026, so at the end of 2025, everybody's tax rate is going back up to the pre-Tax Cuts and Jobs Act. So again, it's something you really need to keep in mind here. You have about 2 or 3 more years before the tax rates are supposed to increase. And so that leads us to the big topic here, which is taxes and retirement. And again, I'm going to pull all of this together here in a minute. But a very famous quote here by Benjamin Franklin: "In this world, nothing is certain but death and taxes." And so hopefully this is not meant to be a doom and gloom message, but to be informational and educational here. So let's paint the picture of what the tax landscape is currently. So right now we're in traditionally a fairly low federal tax rate environment. If you look at traditionally what the landscape has been, we are nowhere near anywhere to the highs that have been in the 40s and 50s. We're actually fairly low from all things considered. So a couple of the ways that obviously we get taxed. First one being federal income taxes. And so just want to make sure you understand kind of the basics of how we get taxed, and then some opportunities there to mitigate taxes in retirement we'll talk more about. But from a federal income tax perspective, obviously everybody is in one of these tax rate brackets. And so the way that you pay federal taxes currently is if you're married filing jointly, you have a specific range of income that you'll pay your marginal tax rate on. And then if you go $1 over that amount, you'll just pay the marginal rate on that extra income. There's different rates for people that file single, but just keep in mind that this is a marginal rate. So anytime you go over, as an example, if you go over the 22,000 as a married filing jointly, then however many dollars over that amount, you would pay 12% on just that amount. So it's marginal. Okay, so that's federal income tax. The other tax that we have here is long-term capital gains rates. And so this applies if you have some sort of investment that you've had for a long term, and you've maybe made some profit on it. Whatever that amount is, you'll pay a percentage. And right now it's capped at 20%. So that 20% is the maximum there on long-term capital gains. And so again, the rates here are different for single, for married filing jointly, and then for trust planning. And you'll notice here for estate and trust, that rate is the number that you have to cross over from an income perspective, or from a profit perspective here, is very small. It's only about $15,000. So again, something to keep in mind here. Another way that taxes creep up in retirement specifically is the taxation of Social Security income. So many people are not aware that Social Security income can actually be taxed. And so the way this is there's a lot of confusion here, so I want to clear this up. But the way this is calculated is what's based on what's called provisional income. Now, provisional income is not the same as adjusted gross income or total income or modified adjusted gross income. There's a separate calculation that the Social Security Administration uses, and that's down here at the bottom. So if you see, your provisional income is made up of your adjusted gross income, your non-taxable interest, and then half of your Social Security benefit. So you calculate all three of those, and that's what's considered your provisional income. And if that number is between these rates here, then that is the percentage of the your Social Security income that is subject to taxes. So hopefully that was clear. But basically, whatever your provisional income is, if it's over 32,000, if you're married filing jointly, then 50% of your Social Security income will be subject to taxes. And then if it's over 44,000, then 85% of your Social Security income will be subject to taxes. So hopefully that is clear. Just make sure you understand I'm not saying that your total income will be taxed, or that the whole Social Security income will be taxed. You have to keep in mind, this is what's called provisional income. So this is separate and different from your actual income, okay? So that's another way. The other way that taxes, especially in retirement, are playing a part here is when you look at the Medicare Part B and Part D surcharges, there's something called an income-related monthly adjustment amount. It's basically called IRMA, we call it. So this is very different than what you might have been thinking about, but the way that your IRMA surcharge, Part B and Part D, is calculated is based on 2 years prior income. So they look back 2 years to see what your income was. And as an example, if you're married filing jointly and your income is $194,000 or less, then there's no a surcharge here. If it's over these amounts, 194 to 246, then there are some premiums. And then every time it goes up, there's an additional premium. The one caveat I want to make sure you're aware of is the way that these rates work is not like a marginal tax rate. So if you're just $1 over the 194,000, so if you're 194,000 and $1, you have to pay the premium. And same thing with the next range. So it doesn't matter if you're just a few pennies or $1 over, you will then have to pay that premium. And a lot of times where this comes in, and a lot of people a lot of people might be thinking, well, I'm not going to make anywhere close to $195,000 or $194,000 married filing jointly. But a lot of times people don't realize you have to start thinking about your potentially pensions coming in, and then your spouse's pension, your Social Security, potentially your spouse's Social Security, and then all of a sudden at age 73, as it stands now, then you'll be forced to take required minimum distributions. And so all of that income can add up fairly quickly if you're not paying attention. And then one of the other big things people ask me is, should I do a Roth conversion? Again, we want to be mindful of these Medicare Part B and Part D surcharges, that we're not tripping these surcharges unnecessarily. And so that's another aspect of that taxes play a role here from a Medicare perspective. Okay, now I'm going to talk about the two types of tax classifications, because there's a lot of confusion around the different types of tax classifications and what's available and what's not. So in general, there's two different types of tax classifications. There's non-qualified, and this would be like a traditional brokerage account or a deferred compensation plan. But most people have their assets in qualified accounts. And these would be like tax deferred accounts, like 401ks or 403bs. But generally this means that it's from a qualified employer plan, generally under the ERISA laws. But for most people's sake, it just means that you're in some sort of 401k or 403b or 457 or some sort of employer sponsored plan. Those are the two main types of tax classifications. And I'm mentioning this because the way that income is treated is very different depending on what type of tax classification you're in. So as an example, the first column here is showing a fully taxable account. The second, and this would be like a traditional brokerage account, for example. The second account here is tax deferred. So you might consider this like a 401k or an IRA. And you're looking to take money out of these accounts here. And then finally, the third one here is going to be tax-free. So this one would be like a traditional, like a Roth IRA. So again, we have a brokerage account on the left. We have a tax-deferred account, like an IRA or 401k in the middle. And then we have a tax-free account or like a Roth IRA on the right. And so as we go through each one of these, you'll see the big difference here at the bottom. But if your current investment balance was about $100,000, and for everything being equal, the same number of years to invest was 20 years, your return was 7% across the board, and your marginal tax bracket was 20%. You'll note, and assuming now you have to add in the after-tax return here, look at the future account value, and then look at the future account value after tax. And you can see that it gets bigger the closer you get to tax-free. So as an example, if you have a Roth IRA of $100,000 and 20 years later, it's grown by 7% in this example, then you can expect to have that $386,000 paid to you after tax, there's no taxes. So it's completely paid to you tax-free, the $386,000. As you look at tax deferred, right, this would be like a traditional IRA or a 401k having to be paid out to you. You obviously then have to pay the taxes on it. And so you have less income coming in from that. And then same thing with the fully taxable account. Of course, having a fully taxable account, the tax drags down that account. So it's important to understand the differences between a fully taxable account and then a tax deferred or qualified account, and then a tax-free like a Roth IRA type of account. And it's important, and it might be that you have different buckets of tax status and tax income in your retirement account. So it might behoove you to have some of these some of your monies in different allocation from a tax perspective. So those are the two different types of tax classifications. And now we're going to discuss the 4 tax implications when moving money. So a lot of people, there's a lot of confusion here when people are talking about moving money from their 401k or the IRA or doing a Roth conversion or required minimum distributions. We're going to cover all of those and the tax implications for each. So the first one, a rollover. So if you have maybe been recently laid off from a job, or you just started a new job, or you are potentially planning on retiring here in the next 5 or 10 years, you might have an old 401k, right? So if you have an old 401k, you can do what's called a rollover into an IRA, and there's no tax implications from moving the money from the 401k to the IRA. The other difference here is if you have a current 401k, so let's say you've been working in a job 30 or 40 years and you have a 401k at your employer, and you want to roll that money out into an IRA so you have more control over the investments inside of that account. You can, if you are age 59 and a half, many 401k providers have what's called a non-hardship in-service distribution. So while you're working, while you're in service, you can take a distribution from your current 401k and roll it over into an IRA. Again, there's no tax implications for doing these if you do them correctly. You have to make sure that it's a direct rollover and that the money is in the name of the new custodian. Some things you want to be mindful of, but if you do it correctly, there are no tax implications here. The next one I want to talk about is a transfer. So this is a lot of people are in this situation. Maybe they took their money from the old 401k and they rolled it over to an IRA, but maybe they're not happy with the investment selection, or they want to roll it over to a new IRA, or maybe work with a financial advisor, and that's a different IRA they have to open. A transfer, again, there's no tax implications from moving from one IRA to, like, if you have a traditional IRA in one company and you want to move it to another traditional IRA at a different company, again, no tax implications here. Conversions. Now, Roth conversions are gaining in popularity right now, especially because the tax rates are a little bit lower. But the way a Roth conversion works is you have money in a tax deferred bucket, meaning you have money in a traditional IRA, that you have not paid taxes on, that you're maybe thinking, hey, I should maybe try to get some of this money off the table to mitigate my tax burden in retirement, you might want to you might consider doing a Roth conversion. And the way this works is you take money, some, not all, but you could do some amounts over many years. You could take some money out of the IRA and convert it into a Roth IRA. You pay the taxes now, but then that money in retirement comes back to you tax-free. One of the other benefits is that it's not subject to the RMD rules or the required minimum distribution rules. And so again, this is gaining in popularity now because tax rates are scheduled to go back up here in 2026. And again, this is also very popular, especially when the market goes down, because you pay the taxes on the conversion amount of the value that's in that account. And so if you were to sell it, when it's lower and then do the conversion, you would pay taxes on the lower amount. So that's two big pluses right now for why people are considering Roth conversions. Okay, next one here is is distributions. And so a lot of people, again, are not taking this into account. There is something called a mandatory or required minimum distribution if you have a qualified tax deferred account. So if you have a traditional 401k or a traditional IRA, the IRS says basically that you must take money out of your accounts. Right now it's at age 73 and it's called a required minimum distribution. And if you don't take it out, there's a big penalty. And that's for qualified accounts. There are also non-mandatory distributions. Those would just be regular distributions. If you had like a brokerage account, you could take money out, or if you had a Roth IRA, you could take a distribution out and no penalty, no tax there. So I want to explain the required minimum distribution again, because we get a lot of questions here and there's a lot of confusion about how to do this correctly. But essentially, when you turn age 73, there's something called a required minimum distribution, and that's the annual distribution that you have to take out of your retirement account the year that you turn age 73. That was changed just recently in the Secure 2.0 Act, and then again in 2033, it's going to change and be pushed up to 75. Okay, so the amount is determined by the fair market value of your IRA at the end of the previous year. So keep that in mind. It doesn't matter what your account value is right now. It might be lower when you end up taking the distribution. Whatever the account balance was at the end of the previous year is what you will pay the RMD, is what the RMD is calculated off of. And so keep this in mind when you're talking about planning for retirement. Another reason why some people are choosing to get more money out into the Roth IRAs, potentially from contributing to a Roth IRA or converting money into the Roth IRA. And so that's a required minimum distribution. And so now that we've talked about the required minimum distribution, I know we're still talking about taxes here, but I want to take a step back so that you understand kind of the landscape of and the timeline of your distributions. And so there's three phases of investing that we generally talk about at our firm Wise Wealth. The first one is accumulation. The second one is preservation, and that's about 10 years before retirement. And then distribution, that's basically from the day you retire onwards. And so there's also something called the critical 15. We use this a lot at our firm, but we believe those 10 years before you retire, up until the first 5 years of retirement, are very critical and crucial to not make a mistake. And we believe this is the time when you cannot afford to make a mistake. So if you're in the critical 15, those 10 years before retirement, or just the 5 years after retirement, this is the time to do that proper planning and making sure that you're mitigating all the risks from a longevity perspective, inflation perspective, healthcare, long-term care, taxes, pension, all these concerns. But the biggest concern that I see most people have, and maybe they can't even see it themselves, is that they do not have a financial or retirement plan. And so I want to bring all of this together and help people understand how to develop your own financial or retirement plan that incorporates taxes into your plan. And so there's 5 principles of retirement planning that we use at our firm. The first one is no investment decisions outside the context of a plan. The plan determines the products. Again, so a lot of people ask, hey, should I do a Roth conversion, or how can I optimize my taxes in retirement? There shouldn't be any investment decisions outside the context of your plan. Don't let your portfolio take a hit, and HIT stands for healthcare, inflation, and taxes. And so we want to make sure that your portfolio isn't ridden down by healthcare expenses, by inflation expenses, and then taxes unnecessarily. The fourth principle here is protect the income and grow the rest. We want to make sure that your income is protected and that you have the ability to be potentially, if you like, be more aggressive in that growth opportunity. And then lastly, financial peace comes from having a plan. And we really believe in the power of planning. So what are the elements of a plan? And we're going to walk through this and specifically more on the tax side here in a minute. But the elements of a plan really should be written down. And it really should include your income plan, your investment plan, your healthcare plan, your tax plan, and your estate plan. And so again, I mentioned at the beginning, every financial decision you make has a tax and estate implications. So it's important that you do not make financial or investment or tax decisions or estate decisions outside the context of a full financial plan. It involves a paradigm shift. ROI. So traditionally in the accumulation phase of investing, we're thinking about return on investment. While in the preservation and distribution phase of investing, we're more focused on the reliability of the income. Again, is it reliable? Is it going to be ridden with taxes or fees or other things that we could have potentially controlled, but we didn't? It's phase-based, so there's three phases. So we have the accumulation phase, the preservation phase, and the distribution phase. And again, if you're on the call, you're probably somewhere in that critical 15, that 10 years before retirement or the first 5 years of retirement. The fifth one here, it addresses all of the risks. And so again, being that we're talking about taxes today, taxes are one of the biggest one of the biggest bills in retirement. And so we want to make sure that it incorporates taxes as a risk, but then also income and inflation and healthcare and long-term care. And then lastly here, it's principles-based and involves a 3-bucket approach. And we're going to go through the 3 buckets, and then you'll see how we optimize for taxes in some of these buckets as well. So first bucket is very straightforward. It's the emergency fund bucket. So if you have any known expenses or purchases here in the next 5 years, we want to make sure that that money is set aside, that there's no risk in the market or from stock market volatility or bond market volatility. We want to make sure that it is safe and liquid and easily accessible. So that's the first bucket, the liquid bucket. The second bucket here is the income bucket. And this is all of the assets that are going to be required to produce your desired retirement income for life. So the way we do that is we first determine your income need. So we focus on your living expenses and your lifestyle expenses and how much is that going to be per month. And then we subtract any guaranteed income sources. So that could be a pension, it could be a Social Security. If you have an annuity, that might be part of your plan as well. And then we want to solve for the gap to make sure that you have that reliable income coming in every month. Then we want to use the least amount of assets to guarantee the level of income that you want. And on the topic of income, we're going to talk more about the tax side of income. But one of the other big things that we mentioned here was Social Security. And so I want to touch briefly on it here because there are tax implications for Social Security and when you should file. And if you already filed, that's fine too. We have some other opportunities there. But in general, the earliest you can file for Social Security is at age 62. And then there's something called the full retirement age. That's when you are eligible to receive your primary insurance amount, your PIA. And that's generally going to be somewhere between 66 and 67 for most people is going to be their full retirement age. And then you can also file late, and that's at age 70. And there's a lot of people that that ask, hey, should I file early? Should I file late? Should I file at my full retirement age? And especially when you're thinking about the tax implications of your total income, meaning from your required minimum distributions, from your IRA distributions, from your Social Security, from pensions, potentially if you have an annuity, whatever that income is, you need to be mindful that all of this income will then creep up and make sure that you don't trip those Medicare premiums potentially if you don't need to unnecessarily. And so the decision of when to take Social Security, again, is going to be one of the largest assets that most people have. But the key way to increase your Social Security benefit is really just to delay it until age 70. For many people, though, they don't want to do that, or based on their income need, they can't afford to do that. And so again, don't make the decision outside the context of a plan, and mainly because there are so many income tax opportunities to optimize for. And we're going to cover each of these here, going over them now. So the Roth IRA, Roth 401k question. I get this question so many times. Should I contribute to my Roth IRA or my Roth 401k? There's a lot of different opportunities there, but generally one of the better reasons why people might contribute to the 401k, the Roth 401k specifically, is that there's a higher limit. So you can contribute more. It's almost 3 times as much as you can to the Roth IRA. And there's also no income limitation. So if you make over a certain amount, you can contribute to a Roth IRA. That's not the case with a Roth 401k or a traditional 401k. But again, that decision needs to be made in the context of a plan. A second one here to optimize income in retirement from a tax perspective, Roth conversions. Again, a lot of people ask me, should I do a Roth conversion? We want to look at all of your income on a timeline, and I'll show you that timeline here in a second. But we want to look at all of your income on a timeline to make sure that you're making the best use potentially of those Roth conversions and distributions. Third one here, timing tax deferred withdrawals. A lot of people are assuming that their tax burden in retirement will be lower. What we've seen though in practice is if you don't take the appropriate actions to prepare, generally your taxes could be higher in retirement. So again, something to keep in mind. Another one here, donor advised funds. Again, if you're charitably inclined, actually the donor advised fund and the qualified charitable distribution, the last one here on the list, QCDs and DAFs are a very great way to satisfy some of the opportunities here for reducing your taxes in retirement. And specifically the QCD, the qualified charitable distribution, if you have a required minimum distribution coming in that you have to take, but you don't necessarily need that money for income, you could potentially just gift it out as a way to optimize your tax amount. Another one here is tax loss harvesting. Again, if you have brokerage accounts that you've maybe lost some money on, there's some opportunities there to harvest some of those losses. Life insurance. A lot of people, mistakenly think that there's going to be some sort of tax implications for life insurance. But generally, when you're thinking about life insurance, it's a great way to pass tax-free wealth to the next generation, if that's of importance to you. Health savings account. Again, this is a triple tax advantaged account. So your money goes in tax-free, the money can grow tax-free, and then the money comes out to you for medical expenses tax-free. So that's a really great way to optimize for taxes there. We mentioned this a hybrid or asset-based long-term care. Again, if you have long-term care concerns, asset-based long-term care could provide potentially a tax-free long-term care benefit. And if you don't use it, there's a death benefit as well. So that it's not a use it or lose it like traditional long-term care. And it provides that tax-free benefit in retirement. And then finally, we want to make sure that we're reducing tax exposure for Social Security benefits and then IRMA or the Medicare surcharges. So again, everyone should have a forward-looking tax planning strategy. And again, I mentioned this timeline here. I want to briefly cover it. So again, if you're in the preservation or distribution phase, and especially the critical 15, the 10 years before retirement or those first 5 years of retirement, it's important to have a plan that you can say, hey, what order am I going to withdraw my assets down in? So is it going to come from my taxable accounts first, my tax-free accounts? I'm not saying this is what you should do up on the screen. I'm just showing this as an example. But again, keep in mind that as you progress, and especially with the RMDs that you don't have a choice, you're required to take those out. Just keep in mind that that income keeps building up as you file for Social Security and then your spouse files for Social Security. Potentially you have pensions, and then of course you have the RMDs, the required minimum distribution. So again, something else to keep in mind. And then the second question here, do you have a forward-looking and tax-efficient withdrawal plan? Again, a lot of people do not have a comprehensive retirement plan, and specifically, they don't have any strategy here to look for tax-efficient ways to withdraw down their assets. And then the third one, how will your income affect your Social Security benefit and Medicare premiums? Again, not many people are thinking about ways to reduce to maximize their Social Security benefit by reducing their tax bill in retirement. So that's the income bucket. And then finally, we're almost done here, the growth bucket. And so really here in the growth bucket, because the income is secured and we've optimized for taxes, really in the growth bucket, we're focusing on determining the rate of return that you need for your goal, taking the least amount of assets for your desired result, and then choosing the asset allocation and a diversified portfolio to make sure that it can withstand potentially any rising healthcare, rising inflation, or rising taxes in retirement. So those are the 3 buckets: the liquid bucket, the income bucket, and the growth bucket here. So if you're excited or overwhelmed about what we're talking about, I want to encourage you to make sure that you have someone in your corner that can help you. And so I would encourage you to book a call. I put it in the chat box here. You can book a call directly on my calendar. The link is in the chat box there. who should book a call? It's really for those in the critical 15, specifically that want the education and the advice on how to build that steady stream of income in a tax efficient manner to reduce potentially their taxes in retirement. Understanding the healthcare landscape, again, is another issue, but how to do it tax efficiently. And then finally develop that peace of mind that really comes from having a comprehensive financial plan. And so what you'll get on this call, we'll go over your current financial situation. We'll discuss your values, your goals, where you want to be financially. We'll look at ways we can optimize on the call. We'll look at ways we can optimize and look for opportunities that we can reduce potentially your taxes in retirement. And then we'll look for opportunities, if they make sense, to implement a Simplify Your Retirement Plan. And the last thing is, if you'd like a copy of the Simplify Your Retirement book, you can also do that. We'll get your address on the call and send it out to you, no charge for that. The Simplify Your Retirement Plan is really made up of these 5 categories. It's the income, it's the growth, it's the taxes, it's the insurance, and it's the legacy. And so we really do take a comprehensive and holistic approach when we develop the Simplify Your Retirement Plan for our clients. And I just want to mention here, as we're closing out, the Wise Wealth, our firm, it's based on Proverbs 24, 3-4, and it says, by wisdom is a house built, and by knowledge and understanding its rooms are filled with precious and pleasant riches. And so the principle there is first wisdom and then wealth. And so I'm appreciative that you're here getting the financial education and the wisdom about your wealth. We are an independent financial advisory firm. We are full service. So we have, and like I mentioned, we have a CPA on staff that we do tax planning and tax prep as well. We are fiduciaries. That means we do what is in the best interest of our clients. And then finally, I just want to recap with our mission. And I mentioned this at the beginning, and I just want to read this top one because I think it's just so important and crucial to who we are. The mission of Wise Wealth is to guide families on a path that makes work optional and to design a plan that empowers the freedom to give, serve, and enjoy life like never before. And really that is our mission at Wise Wealth. And so as we close out here, a couple of frequently asked questions that I get a lot is, what if I want to work with you, but most or all of my investments are in my 401k? That's totally fine. You won't be the first one. There are many ways that you can work with our firm, and we can help you develop a Simplify Your Retirement Plan and making sure that you're optimizing for taxes in retirement. Second question we get a lot is, what if I already have a financial advisor, a CPA, or financial professional? Isn't that enough? And I always say, quite frankly, most people, most advisors especially, are not being tax efficient in their retirement planning, and they don't take a comprehensive look. And so when we develop, it comes down to this: if you want a second opinion, like if you were to go get heart surgery or a knee surgery, your second opinion would always be preferable. And so that's what we offer. We offer, quote unquote, coffee and a second opinion. So again, if what your advisor is doing is perfect, then that's totally fine. If there's ways that we can help you optimize it or make it better, we'd certainly love to do that. And then the biggest question we get is, can I do this on my own? And certainly the answer is yes. If you want to spend the time and the resources and the energy learning and understanding all this information, you certainly can do this on your own. But you'll get so much farther, and you'll waste so much less time by having someone in your corner to help you do that. And so with that, I just want to say thank you so much. Again, my name is David Sandu. I'm a chartered retirement planning counselor and financial advisor here at Wise Wealth. All of my contact information is up on the screen. And if you would like to schedule a call, my link is in the chat box below. And so I just want to say thank you so much. I hope you have an amazing day.